Let's bring in Jared Woodard. He's head of the Research Investment Committee at BofA Securities. Jared, welcome. And since that earnings report, we've been getting a lot of questions about whether a share split should be in the cards for Netflix.
Yeah, thanks. I'm glad to be with you. It's an interesting topic because the cynics will tell you that, of course, a company splitting the shares of stock doesn't change the economic fundamentals. And that's true. But I see it a different way. I think stock splits in some ways are a kind of a triumph for democracy because they make a successful company available to a broader base of shareholders. That's one reason why you've seen companies come back to the market, splitting their shares over the past year at a pace that hasn't been seen before in at least a decade. And as you mentioned, historically, when a company has split its shares this way, it's been a big signal of future outperformance. Our historical work suggests that the typical company, when it splits its shares, sees a return on the order of 20 to 25% over the next year. That far outpaces the market average, which is more like 12%.
What about the elephant in the room, which is NVIDIA, which split almost at the high last summer? I mean, now, of course, it's kind of come some way back, but it didn't enjoy the same kind of boost. And is there any risk that some of the companies now are doing so kind of at these highs?
It's never a guarantee, of course. You can have big volatility in either direction. What we found is that whatever the short-term noise might be, historically stock splits are a sign of strength for a company. A firm has done well, their share price has risen, in some cases maybe to such a high price that it's out of reach for a lot of ordinary investors. And as a signal that they care about those investors, companies often will reduce the share price through a split, signaling their own strength and good economic fundamentals and carrying through on that momentum in the quarters to come. I think that's probably going to be true historically, given the success we're seeing in a number of firms across the market. Today we found something like 40 different companies in the S&P 500 with share prices above $500, a lot of candidates who could split their shares in the year ahead.
Right. In fact, I'm looking at some of them. I mean, it's everything from Eli Lilly to Meta, which has been, a big headline today. What do you think companies are waiting for when they try to figure out how to time and announce a split?
Well, I think they're looking to have a big impact. They want to do it at a time when the news is positive otherwise. When you look at that list, whether it's Netflix or Costco or O'Reilly Automotive, these are firms that have had above average market returns. In those cases, those names are all buy rated by my colleagues at BofA Research. And historically, I think it's been a signal of strength that firms use to tell shareholders, it's not just that our fundamentals are strong, but we want broad participation from the investor base. And so the idea is to time those announcements in a way that can have the greatest impact for the broader investing public.
Quick final question. As this becomes kind of more and more well-known and understood, should someone just hold all of these names going, well, okay, the potential for a split maybe gives me some upside over the next 12 months, and then it becomes like a buy the rumor, sell the fact?
You never know in markets how quickly some signal is going to be completely incorporated into a price. But one interesting fact from the historical work that we've done on this topic is that the distribution of returns historically has been really heavily skewed to the upside. Of course, you never know the future with any individual company. There's downside and upside to be had. But in the past, the companies that have split haven't just seen above average returns. There have been a lot of companies that were having such strong fundamentals that when they split their shares, it was a time when they were seeing profound growth. And so the returns were abnormally high in the distribution broader across the market. It's a really interesting phenomenon.
Yeah, no, and for a while it was quiet. Everyone seemed to be a $1,000 stock in the 2010s. And then last year it looks like we kind of turned a corner on that. So we'll see if Netflix is next. Jared, thanks.